Hey guys, kind of on this last leg of this whole real estate mini series, I guess if you want to call it something like that. One of the big things I want to talk about that you hear a lot of people, you know, it's called a 1031 exchange, right? I want to go over some of the rules and stuff like that you need to know, right? Because in real estate, like a 1031 exchange, it's a swap of one investment property for another that's going to allow the capital gains taxes to be deferred, right? Put off till later, right? So the term, which gets its name from the IRS code section 1031, is, bandied about by realtors, title companies, investors, everyone, right? Some people even insist on making it into a verb, as in, let's 1031 that building for another, right? Stuff like that. So, IRS Section 1031 has many moving parts that real estate investors got to understand, though, before trying to use it, right? An exchange can only be made with like kind properties, and IRS rules limit use with vacation properties. There are also tax implications and time frames that may be problematic. Still, if you're considering a 1031 or are just curious, we're going to go over some of those rules, right? Let's start off with what is Section 1031. Broadly, a 1031 exchange, um, also called a like kind exchange or a starker, is a swap of one investment property for another. Although most swaps are taxable as sales, if yours meets the requirements of 1031, you'll either have no tax or limited tax due at the time of the exchange. In effect, you can change the form of your investment without, as the IRS sees it, cashing out or recognizing a capital gain. This allows your investment to continue to grow tax deferred. There's no limit on how many times or how frequently you can do a 1031. You can roll over the gain from one piece of investment real estate to another, to another, to another, and another, right? Although you may have a profit on each swap, you'll avoid tax until you sell for cash many, many years later, right? So then, if it works out as planned, you'll pay, only one tax, right? And that at a long term capital gains rate, you know, um, say 15, 20%, right? Depending on income, right? And 0% for lower income taxpayers, right? Most exchanges must merely be of like kind. And kind of a vague phrase that doesn't mean what you think it means. You can exchange an apartment building for raw land, or a ranch for a strip mall. The rules are pretty liberal, and you can even exchange one business for another, but there are traps for the unwary. The 1031 provision is for investment and business property, although the rules can apply to a former primary residence under certain conditions. There are also ways you can use 1031 for swapping vacation homes. More on that later, but this loophole is much narrower than it used to be, right? So, in order to qualify for a 1031 exchange, both properties must be located in the US, right? So let's go over, depreciable property, right? Some special rules, right? Just real quick. Um, special rules apply when a depreciable property is exchanged. It can trigger a profit known as depreciation recapture that's taxed as ordinary income. In general, if you swap one building for another building, you can avoid this recapture. But if you exchange improved land with a building for unimproved land without a building, the depreciation you've previously claimed on the building will be recaptured as ordinary income. Now, these complications are why you need professional help when you're doing a 1031, right? Well, there were some changes to the 1031 rules, right? Not here super recently, but I know that they're trying to do some. But before passage of the Tax Cuts and Jobs Acts in December of I think it's 17, some exchanges of personal property, such as franchise licenses, aircraft, equipment, they qualify for a 1031 exchange. Now, only real property or real estate, as defined in Section 1031, qualifies. It's worth noting that the Tax Cuts and Jobs Act full expensing allowance for certain tangible personal property may help make up for this change to tax law. That act includes a transition rule that permitted a 1031 exchange of qualified personal property in 2018 if the original property was sold or the replacement property acquired by December 31st, 2017. Their transition rule is specific to the taxpayer and did not permit a reverse 1031 exchange where the new property was purchased before the old property is sold. Exchanges of corporate stock or partnership interests never did qualify and still don't, but interest as a tenant in common, or a TIC, in real estate still does, right? Well, there's some timing and delay things, right? Classically, an exchange involves a simple swap of one property for another between two people. But the odds of finding someone with the exact property you want, who wants the exact property you have, it's slim, right? For that reason, the majority of exchanges are delayed, three-party, or what's called a starker exchanges, right? In a delayed exchange, you need a qualified intermediary, right, who holds the cash after you sell your property and uses it to buy the replacement property for you. This three-way party exchange is treated as a swap. So there are two key timing rules you got to observe in a delayed exchange, right? So we've got the 45-day rule, right? The first relates to the designation of a replacement property. Once the sale of your property, occurs, the middleman will receive the cash. You can't receive the cash, or it'll spoil the 1031 treatment. Also, within 45 days of the sale of your property, you must designate the replacement property in writing to the middleman, specifying the property you want to acquire. The IRS says you can designate 3 properties so long as you eventually close on one of them. You can even designate more than 3 if they fall within, certain valuation tests, right? So the other one is the 180-day rule, right? So the second timing rule in a delayed exchange relates to closing. You must close on the new property within 180 days of the sale of the old one. The 2 time periods run concurrently, which means you start counting when the sale of your property closes. If you designate a replacement property exactly 45 days later, for example, you'll have just 135 days left to close on it, right? Now, there's some tax implications, right? Cash and debt, right? You may have cash left over after the middleman acquires the replacement property. If so, the middleman will pay it to you at the end of the 180 days. That cash, known as boot, will be taxed as partial sales proceeds from the sale of your property, generally at a capital gain. Now, one of the main ways people get into trouble with these transactions is failing to consider loans. You must consider all the mortgage loans or other debt on the property you relinquish, and any debt on the replacement property. If you don't receive cash back but your liability goes down, that too will be treated as income to you, just like cash. So, suppose you had a mortgage of $1 million on the old property, but your mortgage on the new property you receive in exchange is only $900,000. You have a $100,000 of gain that is also classified as boot, and it's going to be taxed. Well, we talked about vacation homes earlier. Well, let's talk about that. 1031s for vacation homes, right? Because you might have heard tales of taxpayers who use the 1031 provision to swap one vacation home for another. Maybe even for a house where they want to retire and Section 1031 delayed any recognition of gain. Well, later they moved into the new property, made it their primary residence, and eventually planned to use the $500,000 capital gain exclusion. The exclusion allows you to sell your primary residence and, combined with your spouse, shield $500,000 in capital gain, so long as you live there for more than 2 years out of the past 5, right? So it's $250 for you, and if you're married, it's $250 for you and $250,000 for your spouse. So $250,000 per each. That's where they get the $500,000. In 2004, Congress tightened that loophole, though. Right? Sure, taxpayers can still turn vacation homes into rental properties and do 1031 exchanges, Say you stop using your beach house, rent it out for 6 months or a year, and then exchange it for another property. If you get a tenant and conduct yourself in a business-like way, you've probably converted the house to an investment property, which should make your 1031 exchange all right. Per the IRS, though, offering the vacation property for rent without having tenants would disqualify the property for a 1031 exchange, right? What about these people who move into a 1031 swap residence? All right, well, if you want to use the property you swap for as your new second or even primary home, you can move in right away. In 2008, the IRS set forth a safe harbor rule, under which it said it would not challenge whether a replacement dwelling qualified as an investment property for purposes of Section 1031. To meet that safe harbor, in each of the two 12-month periods immediately after the exchange, right? You must rent the dwelling unit to another person for a fair rental for 14 days or more. All right? Your own personal use of the dwelling unit cannot exceed the greater of 14 days or 10% of the number of days during the 12-month period that the dwelling unit is rented at a fair rental. Moreover, after successfully swapping one vacation or investment property for another, you cannot immediately convert the new property to your primary home and take advantage of the $500,000 exclusion. So, before this law was changed in 2004, an investor might transfer one property in a 1031 exchange for another rental property, rent out the new rental property for a period, move into the property for a few years, and then sell it, taking advantage of exclusion of gain from the sale of principal residence. Now, if you acquire property in a 1031 exchange and later attempt to sell that property as your principal residence, the exclusion will not apply during the 5-year period beginning with the date the property was acquired in the 1031, like kind exchange. In other words, you're going to have to wait a lot longer to use the primary residence capital gains tax break, right? Well, what about, the bottom line? What does this all mean? Well, a 1031 exchange can be used by savvy real estate investors as a tax deferred strategy to build wealth. The many complex moving parts not only require understanding the rules, but also enlisting personal help, even for seasoned investors, right? So, I tried to give the basics of a 1031, right? Just enough for you guys to kind of understand what's happening here and like why so many people use it and how they're putting off these taxes and selling these properties and not paying taxes. Because I know a lot of people are like, what do you mean you sold that property for $5 million and you didn't pay any taxes? Well, this is how they do it, right? So I hope you guys got some good information. I hope you enjoyed it. If you're not subscribed to the channel, I'd really appreciate if you did. If you liked the video, give it a thumbs up. Until I see you guys in the next video, y'all be safe.